Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, my guest and I will cover every angle of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate, whether it's national or local, we'll kind of break things down across the country to give you a bird's eye view of what's going on and what the current events that are taking place, how they can affect your ability to get a mortgage, to purchase or sell your home. We're going to give you the things that you need to know. And we're not going to just tell you what you want to hear. We're really here to give you a real sense of what's going on. We strip down what's going on in the media, what the Fed's doing, what Congress is doing, and how that's going to potentially affect your real estate positively or negatively. You can obviously follow us every week on our podcast. We've got a website, realestate360live.com, that we'll post all of our podcasts. And my guest every week is Louis Camerosano, who's a former school teacher, former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as an industry expert, real estate industry expert in the Wall Street Journal, Forbes, CNN, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
I'm doing well. So,
all right.
Obviously, our show ended last week, let's say on Thursday, right? So Friday, we had new home sales that came out, and it was a very dismal report. And you know what? It's already starting to go in the direction that you and I thought it was going to go. We're starting to see, as we progress late into this summer, of things are starting to go sour. And I would anticipate that this is probably going to be the case for till the end of the year, barring no additional quantitative easing from the Fed. And I kind of want to know, because we kind of talked about this, we always talk that it takes, some really negative economic news to drive interest rates back down. And ever since the Fed has basically started insinuating that they plan on tapering the quantitative easing and the purchasing of mortgage-backed securities, which has been keeping interest rates low for such an extended period of time at this point, that even when we have really bad economic news, we're really not seeing a huge decrease in interest rates at this point. And that's not a good sign, actually, because basically Wall Street and everybody else already has it baked in that, we're not going to really allow interest rates to go much lower. We're not going to continue to buy these mortgage-backed securities regardless of when economic news comes out, because they continue to think that the Fed is going to taper regardless of what comes out. Obviously, today, second quarter GDP was revised to 2.5 versus market expectations of 1.8. What is that going to do, guys? That's going to make interest rates get worse again. Now, is 2.5 that great? No, it's not. But once again, the stock market has been thriving off of anything that's positive. Initial jobless claims came in this morning at 331,000 versus the estimated 329. Do you think that would sway it? Essentially, hey, people would say, well, that's a miss. No, they're saying, well, that's close enough, so we're going to, interest rates are going to get worse again. So my point is that no matter what news we're getting at this point, we're not going to see this pullback in interest rates that I think many people are hoping for. Obviously, I think that, we had seen the lows over the last year and a half, 2 years, and we are now moving on to a new range of interest rates, which I think is going to be the range of 4 to 6% of fixed rates. And I think that adjustable rate mortgages will start to fall back down, because it's going to have to be the case, because otherwise housing will come to a standstill. So with all this information that we got, Louis, as far as new home sales, second quarter GDP, initial jobless claims, what's your take on the situation, and where do you think we're headed from here?
Okay, you left out one key point, was durable goods was down as well. Now, if you look at the data in the aggregate, durable goods down, new home sales down, mortgage applications down, GDP up, but GDP up was export-driven, and that clearly won't continue in the third quarter because of all the emerging market issues and so on. So their economies are weak. The exports aren't going to drive the third quarter GDP. Consumption and fixed investment were dismal, so you're not going to see the third quarter GDP increase in the third quarter. However, we seem to be moving inexorably towards tapering just because the Fed said it and the market now expects it September, October, November. You and I have stated all along that the economy is weak. The data indicates that it's weak. The Fed knows that it's weak, but the Fed also said they're going to taper. Now, they also, what I've realized is the amount of QE that they've thrown into the system, Ryan, every month basically purchases 60, 70, 80, 90% of the newly issued debt of the United States. Now, we learned somewhere over the summer that because it was it Freddie Mac or Fannie Mae, they had contributed a large amount of money back to the United States government. So the borrowing needs of the United States for the first time in a long time, at least temporarily, have gone down. So the Fed can actually sneak in a taper, meaning, instead of buying $45 billion a month, they can sneak that down to $35 billion, look like they've done something good, but really all they're doing is masking the fact is the government doesn't need that funding right then and there.
Yep.
So the economy, it clearly is not strong, and you still have this seesaw effect of kind of good economic data, kind of bad economic data, taper, not taper, and that's kind of what we think the Fed wants, is to keep things kind of range bound, and let the air out of the bubble slowly, meaning let rates start to rise higher, but of course they don't want them to rise too much higher. And that's why they started the taper talk assault back in May. Yep. And here we are 3 or 4 months later. The data really hasn't improved, but they can point to this GDP 2.5 as some type of evidence that the economy is improving. And of course, you got Reuters out there again today. When the U.S. initial jobless claim data came out, another tweet, U.S. jobless claims point to a pickup in job gains in August. It's the third time in the third week in a row they put something out like that after the initial jobless claims data has come out. It does not mean that. I don't know how many times people need to hear that just because somebody lost their job, fewer people lost their jobs, doesn't mean more people are going to get jobs.
Right.
It just means that perhaps there's fewer people left to fire at these firms that have done cost cutting for 5 years. It does not indicate that there's more jobs available or that there will be more jobs available. Last week, they went as far as to say that because there were fewer jobless claims, it meant that hiring would happen even quicker. And of course, there's no basis to say that either. So I think we have a situation, Ryan, that the economy is weak. The Fed has said they want to taper. They're probably going to go ahead and do a small taper just because the government doesn't need the money anyway right away. Right. And then, of course, if the economy goes on down, and then, of course, Syria comes into play, there's going to be expenses involved with that. So then they'll say, well, the economy's not doing well because of the war in Syria. We misinterpreted the GDP data. The economy is cratered back again because we tapered. I think as Peter Schiff said, the next taper just sows the seeds for more QE, and I agree with that. So if they do taper, it just means it's a temporary bump in the road. It doesn't mean they're on the way now to getting off the QE. It just means they're taking a break. It's like a hiccup, really.
Yeah,
and before they go and gorge themselves some more.
And
maybe a small burp.
And it's some sort of signal to everybody that maybe everything is turning the corner. Look what the Fed did. You know what I mean? Only to turn around probably a couple months later and find out that we've completely gone off a cliff and now they need to save us again, or feel like they're saving us. They're actually making things worse, as you and I have discussed, every single week. It's interesting because within the real estate industry, we've got Wells Fargo itself that just laid off 23 more people.
Right.
And so I don't know what's more telling when you start to see these mortgage companies laying people off, and this is going to have a ripple effect throughout the industry. What we were seeing, when mortgage applications, about 70 or 80% of them are refinanced, and those go away. These lenders only hire people when they've got that influx of business, and that was created through a low interest rate environment. So, there's side effects to these interest rates rising because there's going to be a lot of people out of work. Banks, I think it was J.P. Morgan Chase that announced back in February that it would be releasing between 13,000 and 15,000 people from its mortgage division throughout the year. So it's almost, J.P. Morgan, they seem to be somehow in cahoots with the Fed. They always are right in. They know
they're an owner of the Fed, aren't they?
They got one of them's on the board, right?
Right. Well, that means they're partial owners of the Fed.
Yeah, and I mean, so they basically are in lockstep with everything that they're doing. So they already knew interest rates were going to rise based upon the information that has been given from the Fed. So to say in the beginning of February that you basically plan on releasing 13 to 15,000 people for this year without actually having, at that point, interest rates hadn't had a drastic increase.
You mean you didn't think that they knew that rates were going to go higher this year?
Yeah, I think they knew the whole time that rates were going to go higher. Yeah, I mean,
because they knew what the Fed actions were going to be,
yep.
And they were going to start this taper talk, and then rates would go higher.
And now we have all the other banks basically following suit. I mean, Wells Fargo is the first big bank, but this is going to be prevalent across the entire industry. I promise, this is happening.
Ryan, what do you think of the rise in mortgage rates? Mortgage applications were down last week significantly, but almost all of that was in the refi. But there was actually an uptick in new purchase applications. What do you make of that?
What I make of it is, and I think we kind of talked about this a little bit a couple of weeks ago, is that there was a lot of people that were out there that were kind of holding out or saying, hey, maybe I'll wait till next year and go ahead and sell my house because now I can get out of it and buy something else. But with the uptick in rates, basically forcing their hand to potentially sell and buy now versus, sitting on the fence, waiting to see if all this smoke's going to clear and rates to go back down. I think that now with almost 1.5% increase in rates, it's kind of forcing their hand. Those people that, were being a little indecisive, I think that it's now forced them to say, yes, we're moving, or no, we're going to stay, right? So I think that that's going to be the trend going through this fall and into the winter. But I'm more curious to see come next spring, once we start, if the tapering does occur, which I still believe that it's not going to happen, to be honest with you. I don't. Not
even a small ceremonial. We don't need the money this month.
I don't think so. I really don't. I mean, because with a lot of the other talking heads that the Fed has there, and they're all saying when the data shows it. I mean, the fact that Bernanke acknowledged it, I just don't think he's going to do anything while he's still, he still has his office there, and potentially beginning of next year would be when somebody else comes in, and that's when they could potentially do something. But I don't think anything's going to happen.
First bold move of Yellen or Summers, as they say.
Right. I don't think he wants to be known as the guy that pulled the taper. You know what I mean? And then
left when the market. In other words, he's leaving as the market's imploding.
Exactly. Yeah. I mean, nobody wants that, right? That would be his complete legacy. I mean, just look how Greenspan left. You know what I mean? And that guy was basically ridiculed for basically causing an implosion of the housing market.
Right.
We've had, what people are saying is, a great little run here in the real estate market, mainly due to what Bernanke's policies have been. And I don't think that he's going to do anything to screw that up between now and the end of the year. So I think that it's going to be much of the same. I'm just curious, like you said, what other world events might take place between now and then that could potentially force their hand to do something?
Well, if they're quote unquote forced, Ryan, then they didn't actually taper, and it's not their fault.
Exactly.
I think that's what they've been looking for, and I think Syria fits right into it, because Syria could be an expensive proposition. Syria could have a destabilizing effect on oil prices, which would be the economy, and therefore the Fed would have, and the emerging markets, and therefore the Fed would have to, so to speak, come in and provide further monetary support. They may not call it QE. They would just say, we're going to do this as a temporary measure, just like a lot of these things are temporary, and then just go ahead and print more money and maybe call it outside of QE. And then they'll examine the merits of the QE program when this crisis is over.
They can always come up with a creative new program name, right? Not call it quantitative easing.
Well, they can actually put QE on hold, not even actually taper it, basically shut it down, but inject new liquidity in the form of emergency crisis money that could be $50-60 billion a month in US Treasuries. It could be higher than QE, and then they say we'll install this crisis money until the crisis is over. Maybe it's never over, but once it does end, then go back to QE. And they'll taper from the crisis amount down to QE.
Yeah, and it's so difficult right now when you're, like myself, I'm a real estate agent that's out there trying to give advice to people, and everything is moving all the time. There's so many moving parts to all this, And, many agents don't have a clue what the Fed does.
Oh, they don't even know it exists or even matters.
They don't even know it exists. They don't know how it's affecting interest rates.
They just tell you buy a home now or sell a home now because I need a commission.
Right, and I mean, and the telltale sign is like when you look at Facebook and you look at a lot of these real estate agents' comments, like they're posting articles from Reuters or all these other different places, which is a bunch of crap for the most part. And it's like they're hanging their hats. Oh, interest rates are rising. Buy now before they continue to go up. I mean, these things.
What were they saying when interest rates are low? There's always a reason to buy. When interest rates are low, they're like, they've never been lower. You got to get in now. When they go higher, they say, well, they're going higher. You better get in before they go even higher.
Right. Yeah.
So there's always a reason to say you should get a mortgage right now.
Absolutely. And even if interest rates were to rise, Louis, to 7%. I mean, I think you brought up the point a while back that obviously home prices would come down, which is not necessarily the worst thing in the world because the affordability then goes up for people.
That's what
I mean?
Exactly. They don't realize that. Well, I better get in now because I want to lock in my rate. But if rates go much higher, the price will come down.
And they're probably. I mean, if we actually did a breakdown of how much would the home prices come back to, they would come back until people could afford to buy them. You know what I mean?
Right.
That's how much they would fall. It's a supply and demand equation. Interest rate is the biggest factor in that equation, and naturally they would fall.
But Ryan, what do you say to the people now who are jumping off the fence? I think it was a very good analysis that you said they're jumping off the fence and realizing, look, I really wanted to buy a house. I was waiting to see the direction of interest rates. They look like they're going higher. I better jump in. How long does that dynamic last, though?
I think that dynamic will probably be for till the end of the year, and maybe even in the January, February.
Which would give people the idea that somehow the housing recovery is continuing when actually that's really the end of it.
Yeah. So, I mean, I kind of look at it, like, okay, I look up and down my street right now. I'm staring right out my window of my house, and I've got houses popping up for sale all around me, all probably original owners when they bought back in like 2004, 2005, when they were paying, $700,000-$800,000 for these houses. Then they went all the way back to $400,000. Now they're back up into the sixes. And what I find interesting is that I mean, this is real world stuff, just like what you were asking me. I think as long as they can get the value on their home that they want, you know what I mean? If they want that $650,000 to potentially break even and get out of their home so they can move on with their life, I think that they're going to continue to do that for the foreseeable future until interest rates make it so that it's not then a smart decision for them to do so.
But that brings more inventory onto the market, doesn't it?
Yeah, I think so. But, I was actually shocked because, a lot of the time we would see, a huge uptick in properties that are coming on the market in the spring, but I've actually seen a huge uptick in properties coming on the market in this late fall market. It's because we had gotten so much appreciation over this past summer. A substantial amount of money that literally in just a couple months that everybody is like, wow, I didn't think that they were going to get there by now, but now we might as well go ahead and settle and move on. And, when I'm advising clients, I kind of look at it, we always talk about this, but it's like my first question that I ask them is not, hey, what do you think your house is worth? Because everybody thinks it's worth more than what it really is. But
right.
It's what is your goal from here? Where are you moving? Do you want to move to a bigger house, a bigger lot, or do you plan on downsizing? Because I guess there's a lot of different scenarios that take place, but really, you can't advise until you know every last thing about that family or person's situation because everything's different. I don't know whether somebody's going to be able to afford to put 20% down or they're only going to have a small down payment. I don't know if their mortgage payment's going to go up on the new house they buy or go down. I don't know if their income's gone up or gone down. There's a lot of factors at play. And, I think most agents, and I don't like to necessarily stereotype them all the time, but I think that most agents just treat it as, I just want to sell their house and climb a new one, and that's the end of it. And I think that realistically now where we're at, you really have to make a smart decision because now that interest rates are rising up, they're still great. Under 5% is fantastic. But are they just getting out of their house to cash out money? I don't really know if that's what they're doing, or are they actually moving into the house of their dreams that they wanted to move to? I haven't been able to quite figure out what's taking place there. If it's just, people wanting to cash in on their equity like we talked about, Louis, you know what I mean? So they can take that money out and consume some more.
Right.
Or are they actually selling because they want to take that money and then go buy the house of their dreams? That is the question to me that I don't really know the answer to, and I haven't seen enough data to really say one way or the other. But I do think that the amount of homes that are being sold right now into the late summer, coming into the early fall, is an interesting thing that I haven't seen in a while, especially in the higher end price ranges, which is still moving, obviously in strategic neighborhoods. But, I think we've had just over the last 3 months almost another 5% increase in just like the last 3 months, which is crazy.
What's interesting, Ryan, about the housing recovery is that it is really skewed towards the higher end, not just in the fact that investors, and in fact the lower end houses were bought by the higher end buyers, which are the investors. Meaning the reason that it wasn't that there were a lot of people, individuals, buying homes over the last year during this so-called recovery. 57% were cash buyers. They were investors like American Homes for Rent and BlackRock, buying up all the low and mid-priced homes to turn into rentals. And then, of course, there's been a tremendous amount of home turnover and flipping in the $1 million plus homes. And that all makes sense, and it's all a direct consequence of quantitative easing because QE drives money into the hands of the wealthy, because low interest rates are only good if you have access to them and you already have money and you have a good job and you own stocks. Well, who owns stocks and who has access to low interest rates and has cash are the wealthy. So they've benefited tremendously from this quantitative easing. But we've seen over the last 2 or 3 years, and I wrote a blog post on this, the recession is was better than the recovery, or the recovery is worse than the recession, is that over the last few years, the average person has lost wage income, from $56,000 to $52,000. So they can't participate in this housing recovery, especially if home prices are going higher. They're making less money, and they don't have access to credit. So people are just pointing to generic figures, but really, if you're in this market and you have a lot of money, yeah, your prices are going to go higher, but you can afford it because you have outsized stock gains. And you have access to credit and jumbo loans. But if you're just working a job and you're making $50,000, $60,000, $70,000, and maybe your wife is making the same, or vice versa, it's difficult to buy a house, especially as home prices go higher. And maybe you don't have stellar credit because maybe you had that foreclosure or short sale a few years back. Now, I know they have programs. We talked about it last week. They've now reduced that time period. But just because they say you can go and get a loan after you've done a foreclosure or short sale after a year, doesn't mean you're in a financial position to do so. Many of those people may now have one spouse not working or now working part-time jobs. So the income and the economy doesn't support this housing recovery. The recovery has been supported by the cheap money at the top layers of the economy. And that's why I have little hope for a housing recovery, and I would think that would make sense. It's almost like there's two sets of advice to give people. If you have a lot of money, is it a good idea to go and buy a boat? Sure. Boat's a nice thing to have. Might as well buy a yacht. But if you're talking to somebody who's not making much money and they say they want to buy a boat, you have to look and say, you crazy? You can't. But the thing with housing is they say, no, you're not crazy. You can, because we're going to put you into this adjustable rate mortgage. What's that? Oh, don't worry about it. You just don't have to pay much for a couple of years. And so it's a much different it's not like you can look at the housing market and say, oh, yeah, it's a good time to buy a house. As you were pointing out earlier, it's a good time to buy a house if your financial circumstances warrant it. And that's the job that the realtor and the mortgage broker, if they're doing their customer any service, have to figure out what their personal circumstances are. Not say, well, home prices are going up, so it's a good time. What is your personal economy?
Yeah, it seems like most agents out there just equate, hey, your home value has gone up, so it's a great time to sell. Unfortunately, that is not a smart decision to just sell based upon what your house value has gone up to, because you still got to go somewhere after you sell it. Where are you going? And you brought up a good point, because I think that there is the third type of seller out there now who bought back in 05, 06, bought in the height of things, right? They took out that large mortgage, was upside down for the last 6 years. They've now gotten to where they've paid down on the mortgage over the last 7, 8, 9 years, and they've gotten to a point where they can sell their house and break even and get out of it. Well, let's just say they might have had a big mortgage that was $4,000 or $5,000 a month. Now, they were the people that said, you know what, we're not going to strategically short sell our house. We're not going to default on our loans. We're going to go with it. We know we have a moral obligation to pay this loan back. We're going to stay in it as long as we have to until we can get rid of it. But their wages have remained stagnant, if not decreased over this period of time, right? So they're saying to themselves, you know what, as soon as we can sell, we're getting out of here so we can get a lower mortgage payment, right? So that's the other seller, is to get out of the house that they're in, that they've been locked into for the last, 7, 8 years, that finally they can just get out instead of maybe having a $5,000 mortgage. Even if they have to go rent, they can rent for $2,500 to $3,000 a single-family home. So I think that is the other seller slash buyer renter on the other side that's just looking to get out from underneath the big debt that they have. You know what I mean? I think
that adds liquidity to the market, but it's not really a sign of a healthy economy.
No, not by any means. And just because, we talk about this all the time, Louis, it's just because the housing market is increasing and people's equity positions are improving doesn't mean anything other than the fact that you got a little bit more money and wealth. Once people consider it wealth once they either cash it out or refinance and take the money out. But if your wages aren't increasing, if the economy is not improving, then it's a farce pretty much. I mean, we're not improving. I mean, we've been talking about this for how long that until we see real unemployment drop to a real 6 or 7% instead of the 16% that we really know it's at, we're going to be stuck in the mud.
And the Fed knows that. You look at the dual mandate. One of the things, I don't know why they even have it, but part of the dual mandate is full employment. But really all monetary policy can achieve is putting money into the economy to support consumption-based, debt-based spending, which in turn, if you believe the Keynesian argument, spurs on the overall economy. But it doesn't, because it requires ever more amounts of spending and ever more amounts of debt to keep that going. And what's happening right now is you have all this spending, but it's not producing jobs. And jobs can only be produced if the money is invested in companies that are going to increase their production and therefore hire people. But what you have instead is this mentality that if we can just get enough people buying houses and moving in and out of existing houses, the economy will pick up. And that is a cart before the horse strategy, because people moving in and out of houses because they have enough money to purchase a house should be a sign of reflective of the health of the economy. But it shouldn't be the driver that somehow if we can just put enough money in the hands of people so they can do this, so they can move in and out of houses and buy stuff, the economy is going to improve. It doesn't, because once you pull the money out of their hands, there's nothing that's been created. There's been no productive capacity to sustain the economy, because now people stop moving in and out of houses, and it's like musical chairs. Then what happens? You're out.
Yeah.
The game's over, and there's still the same amount of chairs. Maybe a couple got broke when people sat down. There's just not enough productive capacity that's been created in the economy. If at all you've created is spending. And a lot of that spending happens on foreign goods too. So it doesn't even create the low-end jobs here. And as we've seen, the big box stores, yes, they've created jobs, but they're now creating part-time jobs. So it's not just the Fed's fault. There's also a regulatory overlay that's also harming the economy, which is an Obamacare.
Right. I mean, we saw this during the last housing bust, if you remember, Louis, when everybody was running and we had these historic home price increases and people were, buying a brand new house and never moving into it and selling it, right? At some point, though, the money that they made on these homes was dumped into another home, right?
Right.
And I will say there is an exception. There were some smart investors that actually got out, sold everything, and just stayed completely out and started.
Like people who sold their internet stocks at the peak.
Right. I mean, there's a few, but they're few and far between. But the majority of those people, they all the money that they made on their house or houses that they bought, they turned around and dumped into another property, and then we saw what happened. They lost everything and then some. I mean, whatever gains that they had, they lost the gains, and then even and more on top of that. So,
right. These are illusory gains that can only that's exactly what this type of monetary policy creates, are illusory short-term gains based on giving people money and telling them to go spend it. And then when the spending stops or they can't give them any more money, the whole game stops.
Yep.
And then you have a crash. And the worst part about it is, at least if you have a crash when you've spent the money, maybe you did some malinvestment in productive capacity and you overbuilt production, well, at least at the end of that, well, let's say you overstated how much production you needed and you built the factory twice as big as you needed, at least you still have the factory.
Right.
And that can be used when the economy comes back. Or maybe you can turn it into housing. At least something was built that can help the economy going forward. You've built an asset. But if all you've done is created economic activity, which is just people moving in and out of houses and taking out loans and selling the house, other than the money that gets spent at Home Depot, there's really not much economic activity or economic growth associated with that.
And that's pretty much where we've been for the last 10 plus years at this point, Louis.
And there was far more. They did a far better job of it from 2004 to 2006, meaning that housing bubble and that consumption boom was far greater than the one now. And that's just the nature of the game when you play this, because each successive time you have to spend more and more money to get less and less of a result. So they spent, you blame, or we blame, or a lot of people blame Greenspan for lowering interest rates. Yeah, he lowered them, but mortgage rates are 6%, historically low.
Yep.
This guy, Bernanke, has not only got the interest rates far lower, he had them down to 3-4% on the 30-year mortgage, but he's also spent money to do it in a manner that Greenspan never did. He's spending $1 trillion a year, and if you think about it, the housing boom or recovery this time is nothing compared to what you had in 2004, 2006 on far less spending of money and far higher interest rates.
Yeah.
So, this housing recovery, now that we've pulled the layer back on the onion, has basically been driven in a very small manner by a small number of investors investing large amounts of money, and it's not widespread. One thing to look at is the number of new homes being built. It's 3 times less this year than it was in 2005, which meant that economy, when they were spurring on the economy, it worked better then than it works now, and that's the only reason that once you go bust, it's much harder to reflate that souffle.
Yeah, and Louis, I don't know if you remember, but when we were doing the show at CBS Radio, it was almost 2+ years ago. Remember when I first had brought up to people about hedge funds and different people buying non-performing notes and stuff like that? Well, this is like 2+ years ago.
That was how you were saying at the time we were in deep recession, how we would get out of it.
Yeah, and like it's so funny because now where we're at is every hedge fund and private investor, they all want to get back into this, which is telling me one thing, that we're coming to the tail end of whatever, you know what I mean? And it's bound to do exactly what happened the last time, which you just bust wide open. And I have a feeling that obviously a lot of these hedge funds obviously have to pay their investors back, but so if they're buying the houses at the right price, they're going to be okay. But the key to those hedge funds is they have to continuously be buying new assets and new assets and new assets.
I have some stats on that, Ryan. I was recently looking into American homes for rent, and I'd like your commentary on this. They've bought about 20,000 homes, and according to their SEC filing, as of June 30th, they said they had about 17,000. They since, as you mentioned, they keep buying more at the date of the filing. But they had only rented 55% of them, which means 8,000 of them are unrented. Now, for how long can they remain unrented and still be able to go back to their shareholders and the board and say, we're doing okay? Well, if they don't rent them, what are they going to do? Well, they can lose a lot of money. They can go bust, and that's a big problem, okay, because then all the homes are owned by a bankrupt owner. Or they could start selling the houses and to artificially inflate their profits, because obviously if you sell a $200,000 home for $200,000 instead of getting $1,200 a month for it, you can show these one-time gains, and you can at least show that you have cash coming in.
Yeah.
So it's not a good sign when the largest or the second largest hedge fund or public company, it's really a public company, buying homes for investment hasn't rented them out. And it's still going out and buying more, as far as I know, because they increased the amounts of homes that they purchased since the filing, and as of the date that they were required to report, I think on June 30th. So how much longer will they go out and buy new homes to keep the housing recovery going? And at what point do they have to focus now on, let's get these things rented? And if I just can't see that if they haven't rented them by now, I'm sure their model doesn't count on there being 55% vacancy rate for a longer period of time. If they can't get those rented, they're going to have to start selling.
Oh, absolutely.
And that's going to have a ripple effect in the market, because now your comps are going to be based on, if you think about it this way, an individual can hold off on not selling a house. That's called, downside sticky, where the owner has a house, they paid $500, and they can pay the mortgage. The house is worth $450. It's not worth selling to them, so they hold it. Well, American Homes for Rent is going to be holding homes that they can't rent out and say, well, it's okay. I know I paid $200 for it. It's worth $195. I'll just hold on to it. No, they can't. They need to pay. They need to get rent money for that. Even if it's worth $210, they're not going to hold it. They're going to get rid of it.
They don't have a choice but to get rid of it. Right. Yeah, and I think, and it's always, you got everybody that's going to jump on board with the whole real estate thing, which is when you start saying, BlackRock and all these huge hedge funds wanting to dump everything, they did billions of dollars into real estate. I knew from when I had started seeing this, when all the, stuff about buying non-performing assets and stuff like that, when it wasn't really out for the public, nobody really knew that was going on. These banks and the hedge funds were able to buy things at, 20, 30 cents on the dollar. But guess what? That's no longer the case. People are now paying, maybe 70, 65 cents on the dollar, which there's a lot less margin for error when you're buying at those prices. And I think that hedge funds just continue to think, and they have to almost think, that, hey, I guess the party's going to continue because the Fed's going to continue to keep interest rates low.
And they're going to continue to buy mortgage-backed securities to backstop their investment.
Exactly. So you have to be somewhat safe. But as we've seen, that's not the case. And I think we're going to see a lot of hedge funds, a lot of private investors, a lot of private money that gets tied back up in real estate, and they have no way to get it back out other than to sell, which then it leads to a bigger problem, because what happens when we have this huge influx in inventory because they need to dump their property?
Right. Now the prices go right back down, and what has the and unfortunately, this is how things work. The executives and the companies who've gone ahead and done this, maybe they lose their job, maybe they won't, but there's really no risk to them, because as the stock price is going up and as the company seems to be on a good trajectory, they're making a lot of money. So they're going to make money to take these risks, but they really don't have the downside, because it's not their money, if the company hits the skids.
Right. It's different than you or I going out there and buying.
Well, then you lose all your money.
Property.
If you were to operate the way some of these companies do, then you would be out of money. If you took your private capital and went ahead and bought a lot of houses with public money, with your own money, and then only rented 55% of them, you and I, if that was our business, I don't know how we would sleep at night. I don't know I'm sure the executives at these companies, they're not that nervous. They don't like it, but it's not like they're going to be economically crushed themselves. That's the problem, and you have to blame the low interest rate environment, because where did they get the money to do this? They went to the public markets, and the public markets are made up of investors who have nowhere else to put their money. They hear real estate's a good thing, so they pour it into these types of companies.
Yeah, they promise them 10% returns, and real estate, is the way to do it, and they get sucked into it. And
when it goes wrong, you know what they're going to say? And a lot of people will say, that's right, who could have seen this?
Yeah.
Well, you and I see it coming. In other words, they will say, just like when the housing bubble crashed last time, they said, who could have foreseen this? And that was kind of the excuse they gave to Bernanke. And he became Federal Reserve Chairman after he made statements like, I don't buy your premise, home price has never gone down, this is not a bubble, this is not, 2005. Yeah. Well, people forgave him. They said, that was like, who could have thought that might have happened? Well, it's the same here. You
Right.
can see what can happen if a company goes out and buys $20,000-$30,000 worth of homes and then can't rent them.
Yeah, I mean, that should be a clear, just big red flag right there that it's just, okay, I think we've pretty much reached the point of no return when, we have institutions buying up that much real estate. And the fact of the stat that you pulled where they've only got, such a really small percentage of the homes actually rented. I mean, to me, you would have been better off to go out and buy a bunch of properties that are already rented, right? Versus buying properties that you have to go in, maybe do some rehab to. But from what I've heard, and I've got some contacts, on Wall Street and some different hedge funds, they're out there trying to pay and overpay for properties just because they have to do something with the money that the public's giving.
Right. That was what I was going to
Right?
say. They couldn't buy what you just described. It'd been harder for them to find 20,000 homes to buy.
Yep.
And they had to spend that money because obviously, if you're going to make a big splash, you can't do it. For you and I, if we raise $5-10 million, it'd be ecstatic. Go out and make a couple $100,000. These guys have to raise hundreds and hundreds of millions in order to make a splash. Well, then they have to spend that money somewhat unwisely because they got to buy something and they have to buy as much of it as they can. But you see, the other thing is there's been on any scale, there's never been this in history where large institutional buyers have become landlords in this way. There's
Right.
companies that have bought these complexes and owned and operated them, but not in the residential. You and I talked about this on the CBS radio show a couple of years ago. We were talking about, why lenders themselves, like Bank of America, just wouldn't get into that business, and I'm sure there's probably regulations why they couldn't. But again, it's a creative solution, but it's one where probably the first one who goes out and tries it is going to make a lot of mistakes.
Yep.
And
Absolutely.
And maybe it's something where the markets will determine, it's probably best left that's just to individual home buyers and sellers. Maybe it's not. But the point being is it's a high-risk move to think that one or two companies on their first shot out the door will go out and purchase tens of thousands worth of homes, renovate them, get them a high vacancy rate, collect all the rent, and give a return on the shareholders. That's a stretch.
Yeah.
But that's what public markets are for. People want to take that bet. And that's why if they fail, no one's going to blame them because it's never been done before. And who could have seen this happening?
So what do you tell shareholders when you don't have but 50% of your properties rented out, and now all of a sudden we have rising interest rates, which will automatically, give the average Joe the ability to think that, hey, naturally home prices are going to start to pull back a little bit.
Actually, well, first, I'll answer the question before you even get to the question. On that particular issue, right now, there's enough verbiage in the media that is saying that higher interest rates are not going to stop this housing recovery. Right? And you laugh. I laugh too. But it's out there.
Yeah.
And because they're historically low, and my point, Ryan, is they're historically low, but so is the labor participation rate is historically low. The economy is at historic lows too. So forget
wage growth. Wage growth is
exactly.
non-existent. Right.
Right. So I'm sorry. Finish with the question, because that's a point where you're giving the assumption that somehow they should know better on that. Well, they don't know better on that. They've been told, and we've been told, that interest rates don't matter to the housing recovery because they're still low.
Because the Wizard of Oz, also known as the Fed, has basically given them no other reason to believe otherwise. I think this is something that, probably maybe a year or two from now, Louis, we can look back and say, hey, we talked about that, and look what happened. This hedge fund or this, institutional buyer ended up going out of business, going under. You know what I mean? Because realistically, that's telling you that there's really not as much of a demand for these rental properties. And I think even what was happening, take a step further, they got a bit greedy because they couldn't get their hands on enough of these houses or assets in the metropolitan areas where rents are typically higher, that they started going into areas that they might not have otherwise gone into.
Well, have you seen their list? It's only like 12 cities. It says like San Antonio. I don't have the complete list in front of me, but it's not your hottest areas. Yeah,
like where their homes are, you could get them for like $100,000 a piece, so they can buy tons of them.
Right.
And Las Vegas, I think they were buying some stuff, Arizona, in areas that were a lot cheaper.
And you have to ask, Ryan, do they look at, and this is what I see in a lot of real estate analysis, they're not looking at the overall economy. They're looking at home prices, perhaps interest rates, but they're not really looking at the ability in the macro sense of people to actually fill this demand.
Yep.
And I think that's the troubling part of all this, because I just read an article by a Bloomberg reporter, and she was talking about why housing isn't dead yet. And, she made some good points, but I think she left out the main reason housing probably can't sustain all this is who's going to buy the houses? Who's going to get the loans? Especially if these kind of large malinvestment type companies aren't going to be pouring more money into this anymore.
Yeah.
So where do you see? That's why I think it's a very important when you're talking to a client is, does the decision to buy a house make sense for you in your circumstances? Because they keep saying macro, oh yeah, housing is a good investment. For whom? For the guy who was making $56,000 a year 2 years ago and is now making $52,000. And by the way, there's far more people in that situation than the people whose situations have improved. If your situation has improved, of course, buy a house and buy a boat to go with it. I mean,
right.
It's not really a hard decision to make. But when you're commenting on the overall economy, there's not as many people able to buy a house and a boat as there are people in the middle class who've lost ground economically. And also this myth that somehow the second half of the year is going to produce more job growth because jobless claims have gone down, that's a myth too. It's interesting. You and I can laugh about this, but that is the standard common wisdom, is that the economy is improving, there's a housing recovery, there's an economic recovery, and all is fine because home prices went up. And look, the stock market's still up.
Yeah, well, and I think you brought up another good point. So when advising my clients, and they basically give me, a short and long-term version of what their goals are, where they plan on moving to another state, they plan on retiring somewhere. If they tell me that, hey, look, I want to sell this house, we probably want to live in the area for another 3 to 5 years, and we plan on moving somewhere, you know what? It might not be in your best interest to buy another property after you sell yours. That's just, if you look at things where we're at now with the interest rate environment. Now, if you're planning on holding that property and not selling it, but you can still lock yourself paying a low fixed rate and you're willing to hold that property, it makes sense if you're upfront and you know that that's your course of action that you're going to take. If you think that you are going to have to sell that house in order to go and retire and you're going to need the funds from there to be able to make that happen, guess what? It might not be the best decision for you to turn around, sell that home, and buy another house just because everybody said, hey, this is the American dream, I want to own my own home. Because you can get in the same situation that happened the last time where, you took your profits, you dumped them into the house, the next house that you bought, and then you can't get them back out because interest rates rose, home prices came down, and you're upside down again. So you have to be somewhat strategic when you're looking at things like this, and I think that it's very easy to just say, oh, no, you know what, we're just going to buy another house just because that's what everybody else does. You know what I mean? And if I've learned anything from the last time, it's, you really need to have your ducks in a row. Because if you don't, guess what? Your 5-year goal turned into a 10 or 15-year goal. You know what I mean? Now you were planning on retiring 5 years from now, but now you're not retiring for 15 years. So, and your house plays a large part in that because that's your largest debt. And it's not like a stock where you can cut your losses in a half a second by going into your Scottrade account and making a click. Well, let's just say this, Louis. We that obviously the price of goods and services and oil and obviously food and everything has gone up since 2005 and 2006, right? So if you bought a house back then for $500,000 or $600,000 and you have a $4,000 mortgage, right? And now you have the ability to get out of that house and you're really not sure what you want to do, but you just know you kind of want to cut your expenses because your wages have gone down or become stagnant, but your expenses have gone up and you really can't afford to stay there and you just want to get out. Wouldn't it be a smart play to say, you know what, I'm going to sell this house. I can rent another home that's the equivalent of what I have now for $3,000 a month, right? And I don't have to feel like I'm forced into a situation to necessarily buy if I don't want to, and I have basically the flexibility and a little leeway to live. I mean, it makes complete sense for if you're making that decision to do that. it's very practical. And could rents rise? Sure. But you know what? At least you have the ability to rent someplace for a year. Even if interest rates go up to 5 or 6%, there's still great interest rates, and you can still, home prices will come back down, and they'll still be affordable if you plan on doing that. But I think that now is a good time if you're planning on making decisions for your future to kind of analyze these type of things. Now, buying a home might be right for everybody. Like I said, if they plan on renting that property out before they move to their next place. But if they don't, one of my clear warnings is be very careful before you take your profits and dump it into the next property. You would agree, Louis, that it's the bigger loan as you could get, the lowest interest rate makes more sense than taking all your cash and dumping it in because you're locking in your long-term costs. You know what I mean? At that low interest rate. So the most amount of money that you can get from a bank at that low interest rate is the smartest way to go. I often hear people that will say, hey, I'll take and throw all my cash into this property, which I don't think is a smart play at all.
I think that's the most common investor mistake. They get a windfall, and then they figure, okay, I hit that right. I got that one out on the top. I made my $1 million. Then they take that $1 million and they throw it at something else, and they think, I'm just going to do the same, and I'm up $2 million. Yeah. Usually what happens is they win on one bet, they pour it all into another, and then they lose it all on the other one.
Yeah, I mean, it goes back to, any successful business. Why do you sell a successful business? You get that capital, and what do you do with it? You have to go find another business or something else to invest it in to continue to make money as well, right? So I guess it's just the nature of the beast. But people tend to get that money, like you said, and then go and blow it on something else, and then it's all gone. You and I have kind of said for numerous years at this point that locking yourself into a low fixed rate, 30-year fixed rate, protect yourself from future inflation. And obviously, we talk about inflation, and people might be saying, well, we talk about it like it's going out of control. It is slowly but surely, and
it is out of control. Gas prices have not been temporarily high; they've doubled in 3 or 4 years, and they stay there. And that's a good portion of you. And food prices too, and housing and rent prices have all gone up because the price of an iPad hasn't gone up that much.
Right.
That's no real comfort to most people.
So if the average person, mortgage is, let's just call it, 30 to 35% of their gross income, and then you have food and gas costs, and which probably makes up at least another 20%.
Right.
Did you say? So how much money is actually left just after those two things? Not much.
Well, if the price of a Big Mac hasn't gone up that well, actually it has. They've done a survey that Big Macs have gone up higher than what they say the inflation rate is. But so what?
Right.
These little items that they put into the consumer price index does not make up the bulk of what your household spending is. And a lot of those things, because they're cheap, maybe you don't buy them anyway. But you can't get out of spending money on food and energy and housing.
No, there's no way around it.
And that's the bulk. Those are the bulk of your expenses, and they're high. But anyway, you were saying with inflation going up, putting yourself into a 30-year fixed mortgage makes sense. However, not everyone can do that. And I think one of the arguments in favor of, and this is the argument they're making, that the housing recovery will continue is rates are low. Sure, and that's a great thing. If you can go ahead and do it, you and I have been saying for years, it makes sense. You can absorb a price loss too, as long as you're getting a low rate and you're paying low monthly payments that you're going to pay for the next 30 years. It's tremendous. But how many people actually have access to that, or forget access, even have the money to go and do that, or the job or the income? And that's where the kicker is, and the reason why the housing recovery cannot continue. The economy is weak, and there aren't enough people in a position to buy these houses, and the people that have been buying them have been investors hoping they're going to find people with enough money to rent them.
Right.
And we're seeing that that's not the case. Until the economy improves, as you say, wage growth, job growth, economic growth, it's not going to happen. If you think economic growth is going to happen because of a housing recovery, it's clearly cart before the horse. Yeah, people can only buy houses if the economy is good. The economy doesn't get good because people are buying houses. It's circular.
We're not even close to seeing any sort of wage growth. That's not happening.
It's wage deflation.
Yeah, and we're so far away from that. It's not even funny.
And if the labor participation rate goes down, that means there's fewer people who have jobs. And one of the key things, if you talk to a loan officer, is What's your income? Yeah, there's people who have income because they have $5 million in the bank and they get interest, but most people get their income from working. And if fewer people are working, fewer people can buy houses.
Yeah, let's take it a step further. What's your income? Okay, now how long have you been at your job? Oh, well, I had this job, then I lost it, then I was off for 2 or 3 months, and now you got a job gap up. You can't get a mortgage now, right? I've got three different jobs. I got these first. Have you been at them for at least 2 years? Oh, well, guess what? You can't get a mortgage. So you've got to be basically top notch, no debt. You know what I mean? Great.
And there's fewer of those people.
Yeah, and the people that are able to, they've got money saved up. They've got down payments. They're solid borrowers. A lot of people have been sitting back waiting for the right time, and they did the right things with their money, and that's great. They can take advantage of low interest rates right now.
And they can trade amongst themselves, but that doesn't help the overall economy.
Yeah, the majority, they can't help. And
the housing market traditionally is not based on luxury homes.
No, it's not.
Can't be. No more than
can't.
The jewelry market is dominated by Tiffany's. It's dominated by, the mid-level chains like, I don't know. My point is that there's certain you cannot, like Gucci doesn't drive handbags. It drives upper-end handbags. Yep. Samsonite maybe drives handbags.
Yep.
It has to be priced towards the middle, just like the Tesla doesn't drive, as a better example. The Tesla doesn't drive auto sales. They sold 25,000 this year.
Right.
That's not a statement on the health of the economy. It's a statement that there's a lot of people with a lot of money that can buy a Tesla. But for them to be successful, or any company or any market to be successful, you eventually have to price that product so the masses can buy it.
Yeah.
And until you do that, you're a niche player. And right now, that's what the housing market is. It's a niche market. And the only reason it's hit the mid and lower levels is because you have investors buying them for rental.
Exactly. Yep. Yeah, I mean, you got mid to lower America, and when we had an extreme low interest rate environment, it made things possible for them. Now that things have been rising out, it's priced a lot of those people out. It's interesting to note, and we'll go into this week's credit tip of the week, which is that there was a survey that was done by findlaw.com that actually found that nearly a quarter of all Americans have never checked their credit score. And why I find that interesting is because basically right off the bat, we've knocked out 25% of the people that could potentially buy, right? Because they don't even have a credit score. So I thought it was actually interesting because the survey and the article actually went into, did you pay attention, Louis, when there were some commercials coming out from like Bank of America and Chase that basically said, there were commercials that would say, hey, you can stop by your local branch and get a free credit score and report. They were offering a free report. Well, why would they do that other than the fact that, guess what? If people don't even have a clue what their score is, and they know that 25% of Americans don't know their score, and they can get them in there for that,
then they can't utilize their services. They can't sell them anything.
Exactly. Yeah, so they get them in there. Maybe they have a 700 credit score. Now all of a sudden they got a loan officer sitting behind the desk that says, hey, well, maybe you can qualify for a mortgage. But when that's where we're at, is that we're having to really, promote these marketing messages to get people out there that don't have a clue about their credit score. Do you really think that those are the people that want to buy a house? Probably not. Probably not. I mean, they're probably not even, that's probably the last thing that they're thinking about is buying a house, right? Because everybody knows that when they go to buy a house that they're going to get the credit pulled. But I just thought that was a pretty astounding fact that over 25% of Americans have never even pulled their credit.
Well, it makes sense because probably 25% of Americans don't have an economic situation where they're even thinking about buying a house. They're just trying to pay their bills. And also, they know if they look at it, it's probably not too pretty, so there's no point looking at it. They know that they owe a lot of money on their credit card and they're delinquent.
So what you're saying is they don't want to see the ugliness that could
Absolutely.
be on the report.
Or they know it's there, so there's no point in looking at it.
Right. It's the old bury your head in the sand, right, and just don't pay attention to it. So you just basically count yourself out from buying. But, guys, once again, and now I'll go back on the whole credit score thing. It is important, obviously. Such a large percentage of the population is not ever checking their credit report, but it is important that you guys check your credit at least once or twice a year, just to make sure that there's not any silly nonsense showing up on there that could potentially stop you from getting a mortgage or a credit card, and to prevent you from paying more interest than you should. That, to me, is the most important. Why pay more interest than you should? And the one way that you can control that is to get your credit score up, make sure that there's not any silly stuff on there, collections, judgments, whatever, but that might not even be in your name. Remember that, you're basically looking at least, probably 1 in 3 credit reports have some sort of error. And more times than not, these stupid errors are what prevents you from being able to buy. The credit pros who I recommend, they can help you get quick resolutions most of the time to a majority of the things that are on your credit report, especially if they're erroneous or banks can't validate the item as being accurate. Don't try to go at it on your own. I promise you, there's been hundreds of people that have done it, and they fought for years, never got anything accomplished, and that there's an easier way to do this, which is let a professional handle that, which is pretty much what we talk about all the time, Louis, which is don't go at anything yourself. Right. Let a professional that knows what they're doing, whether it's a mortgage professional, a real estate agent, a credit repair attorney. That's who you should be dealing with on an individual basis. And in the case that you're dealing with me, I'm working with those people. It's basically we're aligning ourselves, a team of professionals that can handle each and every individual item that we may come across, whether it's getting a mortgage, whether it's fixing your credit, whether it's buying a house, getting you to talk to a real estate attorney because you got something special going on. At the end of the day, you want to be working with somebody that can be your trusted advisor, not just necessarily a real estate agent, because I think, the more the time goes on, Louis, I think that there is a need for people that can actually help people understand, why what's going on is going on and how that actually is affecting interest rates, their real estate, and the future implications of all this stuff.
Right.
So that's it for today, guys. Louis, if anybody wants to get in touch with you, whether they want to, you can talk about your consulting services that you offer and also your blog. Mention your blog so people can come and find your posts. You put on a great blog at smoggle.com. But go ahead and give them the details.
Okay, Ryan, that's about it. It's smoggle.com, SMAULGLD. We put up a post or two every couple of days. So you get 3 or 4 pieces of economic analysis a week on the economy, real estate, Fed, and also we post all of the shows that Ryan and I do on smoggle.com with a direct link over to Real Estate 360 Live and also with a link over to the YouTube channel. So if you go to smoggle.com, you can catch up on what you might have missed or didn't understand during the program today. So hope to see you there.
Thanks, Louis. Appreciate it.
Thanks, Ryan.
Guys, thank you for tuning in once again. If you have any other questions, concerns, real estate needs, we're here to help. I'm here to help. 877-245-2030, or you can reach out via the website at realestate360live.com. That's realestate360live.com. Be sure to share us with your friends and family. That's how we grow. That's how we get this information out there. And like I said, we're here to help. Have a great week.